California faces a projected $18 billion budget deficit in 2025, and the ripple effects are closely tied to the state's pension giants, CalSTRS and CalPERS, whose aggressive investments in technology and AI both cushion and complicate the fiscal picture. Bar chart: current state of California's budget deficit. Deficit size. California is projected to face a $17.7 to $18 billion shortfall in the upcoming fiscal year 123. Drivers of the deficit. Correction spending. Despite closing 4 prisons and trimming payroll, the Department of Corrections is still on track to overshoot its budget by $850 million over 3 years. 4. Structural imbalance. The Legislative Analyst's Office warns the deficit could balloon to $35 billion by 2027 to 28 if spending growth continues unchecked. 2. Revenue paradox. Income tax collections remain strong, fueled by AI-driven stock market gains and tech sector compensation, but expenditures are outpacing revenues. 5. Laptop computer tech and AI context. AI enthusiasm. California's economy has seen a surge in tax revenues from tech workers and stock market gains linked to AI-driven growth. 5. Risk of overheating. Analysts caution that the AI-fueled stock market may be overheated, raising concerns about volatility and sustainability. 5. Budget reliance. The state's fiscal health is increasingly tied to the performance of tech and AI sectors, making downturns in these industries a direct threat to revenue stability. Bank CalSTRS and CalPERS investments in AI. CalSTRS, $358.4 billion fund. Adopted generative AI policies and guidelines. Conducted AI cost-benefit analyses and identified scalable use cases for efficiency. 6. Launched board staff AI governance groups to oversee tech adoption. 7. CalPERS, $500 billion plus fund. Rolled out generative AI reinvention programs, including AI-enhanced customer service and operational efficiency. 8. Positioned AI as a strategic pillar in long-term investment and organizational transformation. Link connections between deficit and pension AI strategy. Revenue cushion. Pension fund gains from AI-related investments help stabilize state finances by boosting returns, indirectly supporting tax revenues through capital gains and compensation. Volatility risk. If AI markets cool, CalSTRS and CalPERS could face portfolio losses, reducing pension stability and increasing state liabilities. Policy tension. The state's reliance on AI-driven revenues creates a paradox. While AI investments bolster short-term fiscal health, they also heighten exposure to market swings. Public finance implications. Pension fund strategies in AI may influence state budget planning, as strong returns reduce pressure on the general fund, but downturns could exacerbate deficits. Pushpin key takeaways. California's $18 billion deficit is driven by structural overspending, especially in corrections, despite strong tech-driven revenues. AI enthusiasm has boosted tax collections and pension fund performance, but risks of market overheating loom. CalSTRS and CalPERS investments in AI are double-edged. They provide efficiency and growth, but tie state finances more tightly to volatile tech markets. The state's fiscal outlook now hinges not just on traditional spending discipline, but on the sustainability of AI-driven economic growth. Would you like me to extend this into a scenario model, showing best-case versus worst-case outcomes for California's deficit if AI markets continue booming versus cooling? That would give you a contest-ready framework for analyzing fiscal resilience.